All right, so let's get right into it. Sun Country Airlines Q3 2024 earnings call.
Yeah, happy Halloween, right?
Indeed. Happy Halloween. It's certainly been a spooky time for the airlines recently.
Oh, absolutely. All the turbulence in the industry.
Right, and this call had a few surprises, I think.
Definitely not your average report.
No, not at all. For example, they actually managed to pull off their 9th consecutive quarter of profitability.
9? Huh. That's impressive.
It is, especially considering everything going on, hurricanes, rising fuel costs.
Yeah, all the headwinds everyone's facing. It's not just surviving either, right? They're thriving.
Exactly, and they're boasting some of the highest margins in the industry right now.
Which, that suggests they're doing something different, right? Something strategic.
Right, and I think that something different is this diversified business model.
Oh, absolutely. They're not just relying on scheduled passenger service.
Right.
They've got this really interesting three-pronged approach. They've got the scheduled passenger service, which is mainly aimed at leisure travelers. Then they've got this robust charter business.
Yeah, I was reading about that.
Yeah, flying sports teams, college groups, even the military. And then on top of that, they've got this rapidly growing cargo operation.
Which is all thanks to that deal with Amazon.
Exactly.
It's really like this three-legged stool, providing stability even when one leg is a bit wobbly.
Precisely. And, that makes sense with how unpredictable passenger travel can be.
Right. Absolutely.
And speaking of unpredictable, that brings us to capacity. Remember all the talk about airlines adding too many flights after the pandemic?
Yeah, everyone was worried about oversaturation and price wars.
Right. Well, Sun Country is actually shrinking their scheduled service capacity.
Really?
Yeah, they're being strategic, responding to the lower demand we see in certain areas. And they're shifting focus to that booming cargo business.
So they're shrinking to grow.
Yeah, it sounds a little counterintuitive.
It does.
But it's a smart move in this environment. By reducing capacity on those less profitable routes, they can focus on maximizing revenue from their most popular destinations, and of course the cargo.
And speaking of cargo, that Amazon deal seems like a game changer.
Totally.
Adding 8 new freighter aircraft throughout 2025.
Oh yeah, that'll significantly boost revenue. And here's the key takeaway. Cargo demand is way more predictable than passenger travel.
Right. So that
more stable earnings, less susceptible to the whims of the leisure travel market.
So we've got this diverse business model. They're making strategic capacity adjustments, and the cargo business is taking off. What about their financial health overall?
Well, their balance sheet looks really solid. They're generating strong free cash flow, paying down debt, and they have pretty modest capital expenditure needs, which means they're in a good spot to weather those storms better than some of their competitors.
It does make you wonder, though, are there any weaknesses, any potential vulnerabilities we should be aware of?
Well, nothing's perfect, right?
Yeah.
One potential concern that jumps out is their reliance on Amazon for a big chunk of that cargo revenue.
Yeah, makes sense.
The deal's been great for them, but it does create a dependency.
Right. If anything were to disrupt that relationship.
Exactly. It could have a ripple effect.
So it's definitely something to keep in mind for their long-term prospects.
Absolutely. Diversification is key, and they've done a good job so far, across the different business segments.
Right.
But having a more diverse cargo customer base could really mitigate that risk even further.
So let me ask you, what are the key takeaways here for you? What should our listeners be paying attention to as we head into 2025?
I think the biggest takeaway is that Sun Country is demonstrating remarkable adaptability. They're not afraid to shift gears, adjust their strategy, and really capitalize on opportunities even in a tough environment.
And that's something we see in other successful companies too, right?
Mm-hmm.
Regardless of the industry.
Oh, absolutely. Being nimble, being responsive to market changes, that's a huge advantage. And for Sun Country, you see it in their capacity adjustments, that growing cargo business and strong financial management. All of that suggests they're well-positioned to handle the uncertainties we see in the airline industry.
Let's dig into some of the specific numbers from the report. I know you love getting into the financials.
Oh, yeah. Always fun. What stood out to me was their CSM, cost per available seat mile. It actually declined by 1.9% year over year in Q3, which shows improved efficiency.
So even with rising costs across the board,
they're managing to control those operating expenses, which is encouraging.
It is. However, their adjusted CSM, which excludes certain items like fuel and special items, actually increased.
Yeah, by 3.7%.
So there are still some cost pressures.
Right. They mentioned higher ground handling expenses, increased landing fees, airport rents, and then the impact of the slowing growth in their scheduled service business.
So a mixed bag. Some costs are going down, but others are going up.
A balancing act, for sure. And it shows how important it is to monitor their cost management strategies closely in the next few quarters.
Absolutely. Now let's talk about their revenue breakdown. What were some of the highlights there?
Well, in Q3, their total revenue was $249.5 million, which was pretty flat compared to last year.
Okay, so holding steady in a volatile market.
Yeah, exactly. Now, looking at the segments, their passenger segment, which includes both scheduled service and charter, brought in $220.3 million, down about 3% year over year.
So that segment's feeling some pressure.
Yeah, their scheduled service revenue took a hit, declining by almost 6%, largely due to a drop in their scheduled service.
Trimus.
Total revenue per available seat mile. It basically measures revenue generated per passenger mile flown.
So they're making less money per passenger mile flown. Why is that?
A few factors, they said: industry overcapacity, the IT outage they had earlier this year, and then those hurricanes in Florida that messed up travel plans.
A combination of internal and external challenges. But their charter business must be doing well. They mentioned a record quarter for charter revenue.
You're absolutely right. Charter revenue was a bright spot, growing 7% to hit $51 million, a new quarterly record for Sun Country.
So they're flying more charter flights and making more money on each flight.
Exactly, a win-win. And it shows the value of that diversified model. When one segment struggles, another can pick up the slack.
Now let's talk about their cargo segment, the big part of their growth story.
Yeah. This segment is a powerhouse for Sun Country revenue, soaring almost 12% to hit $29.2 million.
Another record-breaking quarter.
And what's crazy is that this growth happened despite a slight decrease in cargo block hours flown. Their cargo revenue per block hour jumped 16%.
So they're making more money with fewer flights.
It's thanks to those higher rates they negotiated in their extended agreement with Amazon. Plus, there are annual rate escalations built into the contract.
But is this level of growth sustainable?
That's the million-dollar question. While things look good now, investors will want to watch how this segment performs as they add more freighter aircraft throughout 2025.
Okay, so we've covered revenue and costs. What about their balance sheet? How's their financial health looking?
Well, they ended Q3 with $165 million in total liquidity, which includes cash and available borrowing capacity. A decent cushion to have in these times.
For sure.
And as of October 30th, their total liquidity actually increased to $184 million. So they're building those cash reserves.
That's encouraging. What about debt levels? Are those manageable?
Leverage remains low. They expect to end the year with a net debt to adjusted EBITDA ratio of 2.3 times earnings before interest, taxes, depreciation, and amortization. Basically a measure of a company's overall financial performance.
So 2.3 times ratio suggests they're not overburdened with debt.
Exactly. And they've been generating strong free cash flow, which gives them options, invest in the business, pay down debt, or even return capital to shareholders.
So they're in a good spot to handle whatever comes their way.
They are. And they've been disciplined with their capital expenditures, spending $42.6 million on CapEx so far this year. They expect to spend around $75 million for the full year, mainly on aircraft maintenance and upgrades and technology improvements.
Investing in their core operations, staying competitive.
Exactly. Now, to wrap up this part of our deep dive, let's look at their guidance for Q4.
Okay.
They're projecting total revenue to be between $250 million and $260 million, which represents block hour growth of 2% to 5%.
Modest growth. What about profitability?
They're anticipating an operating margin of between 7% and 9%.
Which is healthy.
It shows they're focused on profitability even in this dynamic market.
So cautiously optimistic about Q4. But the airline industry is unpredictable. What could impact their performance?
Well, fuel prices are still a big question mark. They're expecting their fuel cost per gallon to be 2.47, but any big changes in oil prices could impact their bottom line.
And we can't forget the broader economic environment.
Of course, a slowdown in consumer spending or any global events could really impact travel demand and put pressure on their revenue.
So definitely external factors to keep an eye on. What are they doing internally to manage these risks and position themselves for success?
One key thing they highlighted is maintaining a low-cost structure.
Right, that'll be crucial for staying competitive, especially with those price-sensitive leisure travelers always looking for a deal.
But keeping costs down can't hurt the customer experience.
Of course not.
And they seem to know that they've invested in things like improving their mobile app and offering more personalized services.
Striking a balance between affordability and a positive travel experience.
It seems so.
Right.
And they're continuing to invest in their technology to boost efficiency and optimize operations.
So they're focused on controlling costs, enhancing the customer experience, and leveraging technology to improve efficiency.
And those are solid strategies for this complex market.
Absolutely.
Right.
But ultimately, their success depends on execution, and adapting to unexpected challenges.
For sure.
I think we've covered a lot in this deep dive into Sun Country Airlines.
We have, from their unique business model to their financials to their leadership.
And even with all that, I think there's still one more piece we need to examine their management team.
Oh, right, because even the best business model won't work without the right people at the helm.
Absolutely. So let's start with their CEO, Jude Bricker. He's been in the airline industry for a while now, hasn't he?
Oh, yeah, over 20 years. He's had stints at Allegiant Air and Spirit Airlines.
So he knows low-cost airlines.
He definitely does. And a lot of people credit him with playing a key role in Sun Country's turnaround since he joined back in 2017.
What kind of changes did he implement?
Well, he really focused on improving operational efficiency, enhancing the customer experience, and getting into new markets.
So he makes smart decisions.
And he's known for using data to make those decisions, which is so important in this industry.
I can see why investors are confident in him.
And he's not afraid to take risks. He's shaken things up, challenged the status quo, and that's helped Sun Country stand out from the competition.
Now, what about their CFO, Dave Davis? He's the one responsible for the company's financial health, right?
That's right. He oversees all of their financials, accounting, financial planning, investor relations, you name it.
What's his background?
Over 30 years in finance and accounting. He's worked at Northwest Airlines and Delta Airlines.
Another seasoned veteran.
Oh, yeah. He's been praised for his financial skills and his ability to navigate tricky situations.
Reassuring in this economic environment.
For sure. And he's been instrumental in Sun Country's efforts to reduce debt, improve cash flow, and strengthen their balance sheet.
Playing a key role in their long-term financial stability.
Absolutely. And he's been very active in investor relations, which helps build trust and transparency with shareholders.
So it sounds like Sun Country has a strong leadership team.
They do, which is so essential for handling the challenges and opportunities ahead.
Well, we've really covered a lot of ground today with Sun Country Airlines.
We have their business model, their financial performance, their management team. It's been fascinating.
I agree. It's almost like they defy categorization.
Yeah.
They're not a traditional airline, but they're not just low cost either. They've found their own space and they're doing things their own way.
I like that analogy. They're proving you don't have to be a legacy carrier to be successful. It's about finding your niche and executing a solid plan.
And they seem to have found theirs focusing on leisure travel, those charter flights, and that growing cargo operation. But what does the future hold for Sun Country?
That's the question, isn't it? And that's what we'll explore in the final part of our deep dive. We'll look at their future prospects, the potential risks and opportunities, and what investors should be watching for in the coming months.
Sounds good. Stay tuned, folks. We'll be right back after a quick break. Okay, we're back and ready to wrap up this deep dive into Sun Country Airlines. We've gone over their performance, their strategy, and their leadership. Now let's talk about the future. What's next for Sun Country? Yeah, the million-dollar question, right? Especially in an industry as unpredictable as airlines. But I think we can get some clues from their current trajectory and what's happening in the market as a whole.
So let's start with their growth strategy. They've made it clear they want to keep expanding those cargo operations with those 8 new freighter aircraft coming in 2025.
Right. Huge investment and a sign they believe in the growth of e-commerce and that need for speedy delivery.
Yeah.
But it also raises some interesting questions. Like what?
How are they going to manage such rapid expansion? Can they get the pilots and crew they need to operate these extra flights? And can they maintain that cost advantage as they get bigger? These are things investors will be watching.
Good points. It's not just about buying planes. It's about having the whole system in place to support that growth.
And what about that reliance on Amazon we talked about earlier?
Oh, yeah, that's worth another look. The Amazon partnership has been great for them, but it does put a lot of eggs in one basket. What if Amazon changes things up or decides they don't need to rely on air cargo as much?
Definitely something they need to be ready for. It really shows how important it is to have a diverse range of cargo customers over time.
Now, beyond cargo, they've also hinted at exploring more opportunities in leisure travel, maybe adding new routes and destinations.
But that market's already packed with competition, both the big airlines and the low-cost carriers. So how can Sun Country win in that space?
They'll need to stand out. They've already found a niche focusing on secondary airports and those underserved routes. But they can't stop there. They need to keep innovating to stay ahead. What kind of innovations?
Could be anything, unique stuff on the flights, partnering with travel companies to create package deals, even looking at new technology that makes traveling better.
Thinking outside the box to get and keep those customers.
Exactly. And of course, we can't talk about airlines without talking about fuel prices.
Right. It's a huge cost to them, and those prices are all over the place. It can make or break their profits.
They've hedged some of their fuel costs, but they're still vulnerable to swings in the market.
And right now, the energy sector is a bit of a mess. geopolitics, supply chain problems,
Mhm.
and the move to renewable energy. It all adds to the uncertainty.
So they'll need to watch those fuel prices very carefully and adjust their plans accordingly. Could mean hedging more, looking at alternative fuels, even tweaking flight schedules to use fuel more efficiently.
Sounds like fuel prices are a puzzle for everyone in the industry.
Mm-hmm.
So beyond fuel, what else could affect their performance?
The economy plays a huge role. Obviously, if we see recession or people start spending less, leisure travel often takes a hit.
That would hurt their passenger revenue. And let's not forget things like global events, natural disasters, or even another pandemic. Those can pop up out of nowhere and really mess with travel and airline operations.
Totally. Some countries in the same boat as everyone else. They're part of this big, complex world. How well they can handle these unexpected challenges will determine their long-term success.
So we've got growth opportunities, competition, fuel prices, economic uncertainty, and the possibility of surprises. It's a lot to handle.
It is. But remember, Sun Country has shown they can be resilient and adaptable. They've gotten through tough times before and come out stronger.
That's good to hear.
Yeah.
But for investors looking at Sun Country, what should they be watching for specifically in the coming months?
I'd say keep a close eye on how those cargo expansion plans are going. How quickly are they getting those new planes up and running? Are there any bumps in the road? And how is all of this affecting their revenue and profit?
So track their progress with the cargo side.
Yeah.
What else?
Watch how they're managing costs. Are they able to keep things lean even with inflation breathing down their necks?
Keeping costs down is key in this industry, especially for a low-cost carrier like Sun Country.
And lastly, watch for any news about their efforts to diversify their revenue streams. Are they signing up new cargo customers? Are they exploring any interesting partnerships or ventures that could help them reach more leisure travelers?
So cargo expansion, cost management, and revenue diversification.
Oh,
The big things to keep in mind.
exactly. And as always, pay attention to what's happening in the industry as a whole and the overall economic conditions. Those will affect Sun Country too.
Well, I think we've covered just about everything there is to cover about Sun Country Airlines, their performance, their strategy, their leadership, and what might be ahead for them. It's been a really interesting deep dive.
Definitely. They're a unique company. They're not a traditional airline, but they're not just low cost either. They've found their own way, and they're shaking things up a bit.
And that's what makes them so fascinating to follow. Will they keep succeeding in the long run? Only time will tell, but they've certainly set themselves up well for the future.
I think it's safe to say Sun Country Airlines is a company to watch.
Absolutely. And that wraps up our deep dive into Sun Country Airlines earnings call. We hope you found it helpful and informative. Until next time, keep learning, keep exploring, and keep diving deep.